Today we're going to talk about the disregarded entity LLC versus the partnership LLC. So what does this mean to you? Whether you invest in real estate or run another type of business, knowing this information can really cut your tax bill in a big way. So stick around to the end because I'm going to share with you a big secret to slashing your accounting bill so your CPA doesn't have to fill out a tax form for every LLC you own. Now the average cost to fill out a 1065 partnership form is between $600 and $1,000. So if you have 20 LLCs, say one for each property, this information can save you between $12,000 and $20,000 every year, up to $200,000 saved in 10 years. So this short video is packed with a lot of meat and things you really need to know. So unless you just get a cheap thrill out of flushing money down the toilet, stick around. Hi, this is the business guy with Asset Protection Planners and Lawyers Limited. So when we say disregarded entity or partnership taxation for an LLC, what does this really mean? Disregarded entities and partnerships are IRS tax classifications. Disregarded entity means that the LLC has only one owner, and for tax purposes, not legal protection purposes, the LLC does not exist. So that means all of the income and deductions flow through the company to the tax returns of the sole owner. And if you could flow down and click that like button so YouTube promotes this video, I'd be very thankful. And you can also click the subscribe button and notification bell so that when more videos come out like this, you'll be up to date right away. So that's what a disregarded entity means. It's a tax term. We're also going to talk about the 4 ways that an LLC can be taxed: disregarded entity / sole proprietorship, partnership, C corporation, and S corporation. Now, I remember when I was in the business back in 1994, okay, you can call me the business grandpa if you like, I wrote a book called Insider's Guide to Asset Protection that included a chapter about LLCs. You can get a free copy on our website if you Google that name. And in that same year, many states across the country seemed to be adopting LLC laws all at once. They just spread like wildfire. Why were all these states adopting LLC laws? Because of a favorable tax ruling by the IRS. Now keep in mind, an LLC is like a corporation and a limited partnership got together and had a baby. That is, it has the benefits of each. When somebody sues your business, the LLC can protect you from a business lawsuit jumping over into your personal life and taking away your house, your car, emptying your personal bank account. That protection from the business lawsuit gives it the benefit of a corporation. Then when somebody sues you personally, it has charging order protection to help protect you from losing your LLC and everything inside of it. The charging order protection is like a limited partnership, but it goes even further than just the legal protection. The LLC is also like a corporation and limited partnership for tax purposes as well. The favorable IRS ruling for LLCs look like this. First, by default, if the LLC has only one owner, for tax purposes, it's like the LLC isn't there at all. The IRS says, abracadabra LLC, and poof, it's gone. As the IRS's website says, a single member LLC is a disregarded entity, and the money that LLC makes, or the deductions it takes, should be reported on the owner's federal tax returns, not its own. Now let's make one thing clear. As we said, the LLC is a disregarded entity for tax purposes. So we have how it's taxed in one bucket, then we have how it protects you from lawsuits in a totally separate bucket. So no matter how the LLC is taxed, the lawsuit protection really doesn't change. A properly structured LLC can still protect you from lawsuits no matter how it's taxed. Legal protection and taxation are 2 totally separate issues. On top of that, for federal income tax purposes, a single member LLC classified as a disregarded entity generally must use the owner's Social Security number. If the owner of the LLC is a corporation, it uses the corporation's employer identification number for all information, returns, and reporting related to income tax. For example, if a disregarded entity LLC that is owned by an individual is required to provide a Form W-9 request for taxpayer ID number, the W-9 should provide the owner's Social Security number or EIN, not the LLC's EIN. So yeehaw LLC, we're going for a ride. All of your money goes onto my personal 1040 form. On the other hand, now pay attention to this, a single member LLC will need an EIN if it has any employees or if it needs to file excise tax forms. So that's because a single member LLC that is classified as a disregarded entity for income tax purposes is treated as a separate entity for purposes of employment tax and certain excise taxes. Now, I live in Florida, so let's say I set up a Florida LLC. Then if it's for a client and the client wants this service, I'm going to have our legal department contact the IRS and get a tax ID number if needed. Now, on the IRS forms, you have 4 options. The U.S. LLC can be treated as a disregarded entity / sole proprietorship by default if it has just one owner. Number 2, a partnership by default if it has 2 or more owners. Number 3, a C corporation by electing corporation taxation on an 8832 form. Or number 4, an S corporation by filing the 8832 form electing corporation taxation plus the 2553 form asking for S corporation election. Now, just to cover my butt here, this is just for general discussion purposes only. So before you do anything we're talking about in this video, get advice for your situation from a licensed CPA. So to review, what do we mean by disregarded entity? To start off, as we said, to be a disregarded entity, the LLC can have only one owner. So if it was your LLC, in order to be classified as a disregarded entity, you would have to be its only owner. So we could set up, for example, a Wyoming LLC, and you're the only owner. You don't have to file any additional tax forms for it to be taxed as a disregarded entity. It's automatic if only you own it. Okay, now my favorite jurisdiction for LLCs in the world is Nevis, the Caribbean island of Nevis, Nevis. You can see our video on the benefits of a Nevis LLC to see why it's so incredible for legal protection. You'll see why Nevis has the most incredible LLCs in the world. Now, for a foreign LLC, your CPA will file an 8832 form and check a little box to have it taxed as a disregarded entity if you're the only owner, or a partnership if there are 2 or more owners. With a foreign LLC, you have to let the IRS know that you want it taxed as a disregarded entity or partnership. For single-member U.S. LLCs, it's automatically treated as a disregarded entity for tax purposes, and for U.S. LLCs with 2 or more members, it's automatically treated as a partnership for taxes. So for U.S. LLCs, disregarded entity status is automatic. So for single-member foreign LLCs, file the 8832 form right away and elect its tax status. It's really simple to file, by the way. A 5th grader could fill out that form. But just to cover our backsides, we always recommend you have a CPA do it for you. Now, here's an exception where a disregarded entity can have 2 owners. You need 2 things. First, the owner is a married couple, and 2, if they live in a community property state. And the cool thing is this: in community property states, where a married couple is the only owner, the IRS will accept the LLC as a disregarded entity, and the IRS will also accept the LLC as a partnership for federal tax purposes. So you really have a lot of flexibility. There are 9 community property states: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. Though it's only 9 states, it includes the 2 most populous states, California and Texas. So for that reason, 25% of the U.S. population lives in a community property state. Now, outside of those states, the IRS will treat the LLC as a partnership by default for tax purposes when 2 or more people own it, whether they're married or not. Okay, back to disregarded entity. What does a disregarded entity really mean in practice? Let's say you buy a rental house in your single-member LLC. From the IRS's viewpoint, the LLC doesn't exist. For tax purposes, you own the house. Again, this has nothing to do with the asset protection that the LLC provides. Some people think because the taxes flow straight through that the lawsuits will too. But this LLC is like bulletproof glass. The taxes represent the sunlight that shines straight through. The lawsuits represent the bullets that cannot easily penetrate a properly established LLC. And again, I emphasize properly established. It only costs a bit more to have an LLC established professionally, but it can save you hundreds of thousands or millions of dollars in legal fees and asset seizures by having it done right. And again, we have lawyers on our staff who you can call and get this done right. And I don't mean those mean lawyers that you see on TV shows, nice ones who are easy to talk to, so give us a call. So this rental house spits out $24,000 a year. I put that right here on my 1040 form. So we set up 1 LLC per property so that the liability is limited to just 1 property. So if a lawsuit hits this 1 house, it doesn't hit all of these other houses over here. Now people will ask me, well, how does this affect my taxes, all these LLCs? Not at all. And they say, huh, what do you mean? And I say, well, how do you file your taxes now? And then I say, just like that. You don't change how you file your taxes on disregarded entity LLCs. Then again, they ask me if they have asset protection. And I remind them, How it's taxed and how it protects you are two separate buckets. Now, what about LLCs taxed as partnerships? How does that change the game? Say you have two or more owners, you live outside of a community property state, and you and your spouse own the LLC together. So I set up an LLC in Nevis, my favorite place in the world, or in Wyoming, my favorite state. Now, I live in Florida, not a community property state. My wife and I have been married for 32 years, still happy, love being together, still hold hands when we walk down the street. Neither of us are going anywhere. But since we don't live in a community property state, what do we do if we don't want to pay the CPA to fill out a partnership tax form 1065 for every LLC that we own? Here's the secret. You ready? A Wyoming LLC has charging order protection for single member LLCs, and a Nevis LLC is even stronger. That is, when somebody sues you, there are provisions in Nevis LLC statutes such that the judgment cannot take your company away from you or the assets inside. So you can set up a Nevis LLC. That Nevis LLC will own 100% of all your other LLCs. That way, every LLC that your Nevis LLC owns is a single member LLC. It does not have to file its own tax forms. So you have 10, 20, or let's say you even have 50 LLCs, one for each rental property, and your CPA charges you $800 per 1065 form. That could save you $40,000 every year in tax preparation, and in 10 years, you just save $400,000 with that one simple trick. Aren't you glad you're watching? So you have one Nevis LLC with 10 US LLCs inside of it. Those 10 US LLCs don't have to file tax returns. Their income and deductions just flow right through to the one main LLC, and you report it all on your own 1040 form, Schedule E, if your Nevis LLC is a disregarded entity. Or for a step down in protection, we can also do Wyoming too. But why not pick the strongest LLC? Super simple. So having or not having these LLCs changes nothing tax-wise, but what you've accomplished is a whole lot of lawsuit protection so you don't lose everything you've worked so hard for in one lawsuit. And even if your Nevis LLC is treated as a partnership for taxation, because two or more people such as you and your spouse, or you and your kids, or you and another business partner own it, it doesn't even have to be a person. It can be another company you set up that owns, say, 1% of the company. Since one LLC treated as a partnership owns all of the other LLCs, it's only that one LLC's 1065 form instead of 50 or 20 or 10 of them, making your life a whole lot simpler. So when you have a disregarded entity, you report all of the entity on your own 1040 form. And if there's another member, you report the income and deductions on the 1065 partnership tax form. By the way, that LLC that is treated as a partnership pays no income tax either. The 1065 partnership tax form just provides information to the IRS on how much that LLC has made for the year. Then that return is going to pop out another number saying, here's how much this partner needs to report on his or her personal tax returns. Say the Nevis LLC, or Wyoming for that matter, has two partners owning 50% each. If they're married, the LLC spits out a K1 form that shows how much income or how much of a deduction the partners get. That K1 form is attached to the partner's 1040 form. That will also show up on your Schedule E of your 1040 form, just like the disregarded entity income does. You just list your real estate on that form. Maybe you have several pages because you have a lot of real estate. So in other words, you take the 1065 form, that number is reported on your K1 form, and you take that number off your K1 form and put that on your personal 1040 form, Schedule E, page 2, under income or loss from partnerships and S corporations. Have your CPA do this for you. So it boils down to this. I want to own all my LLCs in one master Nevis LLC, so I save myself a bunch of money in tax preparation fees. So that way you're not complicating your life, you're keeping things simple, you have your liability protection, and you're not paying big bucks to somebody for filling out unnecessary tax forms that you wouldn't have to pay if you just set up everything properly. Now, why would you want to have your master LLC as a partnership instead of a disregarded entity? Mainly because there are fewer tax audits on 1065 forms than there are on personal 1040 forms. On your 1065 form, it just spits out a number that you transfer over to its corresponding K1 form. Otherwise, you would have a whole lot of detail going down there on your 1040 form, and this could be subject to more scrutiny. On top of that, it's easier to get loans if you just show the lender the K1 form rather than a whole rat's nest of detail on your 1040 forms. So those are some of the reasons for having your master LLC as a partnership. Plus, if your local judge enforces local laws, such as California, Florida, or Texas, where they don't give single-member LLC charging order protection, you're going to get better protection anyway by having your Nevis LLC have 2 members instead of 1. In addition to the lawsuit protection, lower risk of audit, easier to get loans, that's why any skilled real estate investor who's been around the block a few times holds each property in a separate LLC. So instead of having 40 disregarded entities reporting all sorts of required garbage on your 1040 form and making it look like a jumbled mess, you simply have one K1 form wrapped up in one tidy package from your partnership / Nevis LLC. So that's why I like the master LLC to be treated as a partnership. So if you're just starting out and have just one investment property, treat the LLC that owns it as a disregarded entity. And that's fine. It'll just go into your personal tax returns. And it's easy for us to change things later when you grow. All you have to do is bring on a partner, such as a spouse or a buddy or a child or grandchild, or just have us form a second company to act as your partner to your master LLC. Then we set up another LLC that collects all your rent for all of your properties, and it has the bank account. So anyway, I hope this helps. That's what a disregarded entity is, and that's what a partnership is, and how you might want to structure your affairs. So please click like, subscribe, and share this video with others. Thanks for watching. This is The Business Guy.